In this week's video, we'll review the latest charts to help us answer the question, does the stock market look more like October 2018 or October 2016? This is a chart that we covered in the Friday, July 11th video of the S&P 500. If good things are going to happen in the stock market, it's extremely important to keep in mind the S&P 500 is still near this rising trend line, and it is possible that we still could see a 3 to 5% pullback even if bullish probabilities prove to be helpful. I want to make it abundantly clear that is not a call for a 3 to 5% pullback. It's just making sure we're in the right frame of mind heading into an important week with the Fed and a non-farm payrolls report. Wouldn't be shocking if the market came back and revisited either 29.50 or 29.25. In this week's video, we'll continue to do what we've been doing all year. January 4th, hard data that we had in hand told us to be open to the possibility of a bottom in the S&P 500. This February 2019 post on short takes told us to keep an open mind about better than expected outcomes in the months and years ahead. In April, the hard data told us to keep an open mind about much better than expected outcomes in the years ahead. And if you haven't seen it, you can find a recap of much of the 2019 research in this post. You can Google this title here. As we move forward with the 2019 charts, we'll continue to leverage this concept here. You can see on the S&P 500's weekly chart on July 25th, we could draw a rising trend line here, so we're still in an area of possible resistance. The market will decide if it wants to push higher or come back and do some form of a retest. Market breadth has been sending mixed signals in recent sessions. Thus, a fair question might be, are we basically going to see a very, very similar outcome in the present day to what happened after this peak in October of 2018? We're going to be looking at several charts here. They're noisy, but they're very, very easy conceptually if we walk through them step by step. This is a technology ETF, VGT, relative to long-term treasury bonds, TLT. This is a weekly chart with Bollinger Bands. This is the ratio here of tech stocks to long-term treasuries. This is the S&P 500 on the bottom of your screen. Notice tech stocks were extended above the upper weekly Bollinger Band on a closing basis prior to this sharp decline in the S&P 500. Similar situation here. You can make an argument that tech stocks are extended with a close above the upper Bollinger Band, and this occurs after a nice run in tech stocks relative to treasuries. After we could see this, really bad things happened in the stock market. Do we have a similar and worrisome and extended look on this chart in the present day? The answer is no. We have a much more constructive look during the session on Thursday, July 25th, with the ratio above the center line, a rising center line, and below the upper Bollinger Band that's trying to turn back up. Similar situation here. Now we're looking at SPY monthly relative to long-term treasuries, or TLT. This is the peak in the S&P 500 that occurred on January 26th. This is the peaking process here in late September, early October 2018. You can see the ratio of stocks to long-term treasuries is near the upper Bollinger Band here. And prior to the decline in October of 2018 in the stock market, we had that extended look with a monthly close above the upper Bollinger Band, and this comes after an extended run. The look of the ratio here relative to the Bollinger Band is quite a bit different than the look here, where the ratio was below the center line, closer to the lower Bollinger Band, and then it was able to rally above the center line that was turning back up. After this look, really good things happened in the stock market. After this look, really bad things happened in the stock market. Therefore, the million-dollar question is, does a present day look extended like this or more constructive like this? On a relative basis, it's pretty easy to answer that question. The present day looks a lot more like this period here and really doesn't look anything like early October 2018. All of this simply speaks to probabilities. Doesn't predict anything, doesn't tell us that we can't get a pullback even within the context of bullish outcomes, which overweights lower volatility sectors in the S&P 500 index. When the stock market was trying to turn between June and October 2016, this is the S&P 500 on the bottom of your screen where my cursor is, you can see the ratio was extended in a bearish manner with a monthly close below the lower Bollinger Band. And then in this area here, it started to rally back towards the center line. This look here is in stark contrast to this extended look here that occurred after an impressive and lengthy move in the ratio. This look here in October of 2018, you can make an argument, is even more concerning than this. Why? Conviction here is more tepid. This white space here relative to this push here speaks to waning momentum in the SPY-SP low volatility ratio. Thus, the million-dollar question, does the present day look concerning and extended like this look here? Or does it have a slowing momentum look like this period here before really bad things happened in the stock market? Or does the present day look more like this constructive look that occurred before a lengthy move in the S&P 500 index? The answer is very, very simple. July 25th, 2019, unequivocally, unquestionably, undebatable, this looks a lot more like this constructive look and really doesn't look anything like this overly optimistic look here in early 2018 or this waning momentum look here after a long run in October of 2018. Should also be noted, this move in here, which retests this breakout, this is a monthly chart of the S&P 500, this is a 5.6% correction, reminding us that we should have realistic expectations even if bullish odds prevail over a longer time frame. Similar concepts here. Now we're looking at market breadth. S&P 500% of stocks above the 200-day moving average. We have three separate looks here. The constructive look, extended in a bearish manner, you can call this oversold. Eventually, we make a higher low, make our way back to the center line on the monthly Bollinger Band, and then push above the center line. This look here coincides and came before this nice move here in the S&P 500. That's quite a bit different than the look here, where we're really not making any progress and we're moving sideways and the upper Bollinger Band is falling toward price here. This look here is even worse and more concerning than this look here. We can see this before really bad things happen in the S&P 500. Why is this worse? It's telling us that fewer and fewer stocks were able to move above their 200-day moving average during this rally relative to these moves over here. This is a sign of weakening participation or weaker breadth. Thus, the million-dollar question, does the present day look like this, or this? Once again, the answer is very, very simple. We're looking at facts. This constructive period here, the indicator makes it above the center line. The center line eventually turns up. The indicator makes it above the center line. It looks like it might be trying to turn up. This is in the early stage of a move after a monthly close below the lower Bollinger Band. After a monthly close below the lower Bollinger Band, we eventually make a higher low here. In this case, we eventually make a higher low here, and in this case, a higher high is step 3. We're completing step 3 or attempting to complete step 3 in the present day. That will be determined on July 31st, 2019, since this is a monthly chart. Also noteworthy, step 3 here occurs after the S&P 500 has been moving sideways for a long period of time and coincides with the attempt at a bullish breakout. Coincides with the attempt at a bullish breakout after a long-term period of consolidation. None of this predicts anything. It just tells us that the present day looks more like this constructive period relative to this concerning period and this even more concerning look here. Is there anything else in the present day that ties this period here to this period here? The answer is yes. We could provide many examples in the bond market. Switzerland's 50-year bonds, negative yields. When was the last time that we saw something similar? July of 2016, which is right here, before good things happened in the S&P 500. You can make an argument that this is your irrational exuberance look in the bond market. You can make an argument that this is a bond market that is overbought. Is it possible that the bond market continues to stay in an overbought state? The answer is absolutely positively yes. It simply speaks to longer-term probabilities in both the bond market and the stock market. How about the VIX? This would be the look that we would want to avoid in the present day. S&P 500 peaks and the VIX shoots straight up. We get weekly closes above the upper Bollinger Band. Similar situation here as the market was peaking in October of 2018. Right here, we can see this close above the upper Bollinger Band. How does the present day compare? In the present day, the upper Bollinger Band on July 25th, 2019 is starting to turn down. The center line starting to turn down with the VIX below the center line. The lower Bollinger Band starting to turn down. Not the case here. Turning up, turning up, turning up, turning up. Pretty easy to say. The facts that we have in hand today, this looks quite a bit different than this or this. This really doesn't help us from a prediction standpoint. It helps us more from a what to look for in what could be the early stages of a sharp move down. You can find this tweet on our Twitter feed. It's extremely important to note. A rising VIX does not mean stocks are doomed. As we mentioned earlier in the video, market breadth has been very, very jittery, telling us to keep an open mind about all outcomes, especially in the short run. The jittery look of present-day market breadth is similar to market breadth in late 1999, early 2000. It is also similar to jittery market breadth that was in place prior to the S&P 500's peak in October of 2007. And the jittery market breadth in the present day has some similar characteristics to market breadth in the summer of 2015. All of that is 100% factual. It's sound analysis and something that we should be aware of. Thus, it might be helpful to compare the present day to these three periods. In the present day, if we look backwards from July 25th, 2019, 545 calendar days, the S&P 500 has really gone next to nowhere. It's up 4.55%. That's from this point here to this point here. Maybe more importantly, from a psychology perspective and fear perspective, it has only been 213 calendar days. Only have to look back 213 days in the rearview mirror to find a decline, a shocking decline in the market, a gut-wrenching decline in the market of 19% or greater. This is the base theory that we've talked about in recent weeks. We are not extended from a base in the present day, and we just had what is basically a bear market. This decline here fell just short of the somewhat arbitrary 20% threshold on a closing basis. If we look in the rear view mirror, we basically have the characteristics of a major low 213 days behind us. How does that compare to these periods here? Is the present day similar to this major peak here that occurred on March 24th, 2000 in the S&P 500 index? We believe there are some significant differences. Instead of gaining 4.55% over the last 545 calendar days, if we look backwards from this point here, 545 calendar days, the S&P 500 was up 46%, over 10 times more than what we have in the present day. This speaks to an extended market relative to the present day market. In the present day, we only have to look back 213 calendar days to find a major low. This is a major low until proven otherwise. In this case, we have to look back 571 calendar days to find the low of a decline that was 19% or greater. The psychology and asset allocation, cash levels, confidence levels, all quite a bit different here than they would be in the present day. Similar situation, S&P 500 peaked on October 9th, 2007 on a closing basis. If we look backwards 545 calendar days, instead of being up less than 5%, we were up over 21%. Instead of the last major low occurring 213 days in the rearview mirror, we have to go back 1,826 calendar days to get the psychological blow that investors were just dealt here. Market psychology, allocations, overconfidence levels, etc., most likely quite a bit different on this day relative to this day. That does not negate the similarities in the present day, but it's important to understand the significant differences as well. How about the spring and summer of 2015? If we look back 545 calendar days, instead of gaining less than 5%, we were up over 18%. How far back do we have to go to find the last gut-wrenching 19% plus decline? Answer, 1,326 calendar days, which is quite a bit longer than 213 days. The present-day market has unquestionably the lowest return, meaning we are not extended in the present day like we were here, here, or here. And the present day unquestionably has the characteristics of a major low very close by in the rearview mirror relative to this, and this. All of it simply speaks to probabilities and risk relative to reward in the present day. Risk-reward ratios can be very favorable after a breakout from a base. The million-dollar question in the present day is, will the breakout hold? The probabilities say eventually yes. In the short term, much more difficult to make any definitive statements about probabilities. As we know, we don't use any of this to forecast. We're simply comparing the facts that we have in hand today to the facts that were in hand near these major peaks. Let's check in on the status of our 30, 40, and 50-week moving averages. This is the look we want to avoid, the look we want to avoid, the look we want to avoid. This is the type of look that we want to embrace, 1995. Much more constructive look in 2003. Much more favorable look after the bottom in 2009. And this more constructive look here really didn't look anything like the 1987-1988 period. Once again, we're looking at facts that we have in hand, no opinions, no emotions involved here. It's pretty clear that this look here on July 25th aligns more with the bullish probability cases relative to the bearish probability cases. Let's shift gears for a moment and talk about the economy. This is U.S. GDP since the major 2009 low in the stock market. This is 2019 on the right side of your screen. As we can see, the concept of slowing growth isn't necessarily a death knell for the stock market. Something else that you might have picked up on this chart. From a trend perspective, the left side of the chart looks quite a bit different relative to the right side of the chart. You can make an argument that the economy and spending habits looked more like a period of consolidation and confusion. This does not look like high economic conviction. This is calendar year 2013 here, and this is the look of the S&P 500 in March of 2013. The market had basically gone nowhere. This is 2013. We can go all the way back to the peak in the dot-com era here in the year 2000. Market fractals tell us this is long-term consolidation. This is not a market that is extended from a base. The right side of this GDP chart looks a little bit more like higher economic conviction, and it occurs after the S&P 500 breaks above prior resistance. We know the longer a market goes sideways, the bigger the move we can expect to get. And you can make a rational argument that the secular bull market began right here in 2013. Prior to this, we were in a gigantic trading range. If this were a 60-minute chart, you wouldn't have any problem at all calling this a trading range. Fractals tell us it's the exact same concept on this daily chart that spans several years. You can also make an argument that the trend in GDP is up. This low here is lower relative to this low, making this a higher low. This is a higher low relative to this low and this low. This period here, after the breakout, is discernibly different from this failed breakout look here, this failed breakout look, this failed breakdown look, and this failed breakdown look. This period here looks a lot more like confusion in a trading range. This period here looks a lot more like confusion in a trading range. Since this breakout here, it looks a lot more like a secular bull, and GDP since then seems to be a little bit more stable relative to consistent economic conviction. Anything else that would align with the secular bull market thesis? Yes, as we covered a couple of weeks ago, the S&P 500 is trying to nail down a monthly bullish MACD cross, a relatively rare intermediate term monthly MACD cross. We won't know until July 31st whether or not the cross is in place. During the trading session on July 26th, it was in place. Did anything like this occur during the dot-com bear market or the financial crisis bear market? The answer is no. And we know from the video a few weeks ago Much like the concept of a secular bull market, similar cases from history tell us to keep an open mind about much better than expected outcomes in the S&P 500 over the next 5 years. This would be 5 years hypothetically from July 31st, 2019, if the bullish cross is in place at the end of the month, which is to be determined. GDP report on Friday, consumer spending highest since Q4 of 2014. Credit spreads tell us a lot about economic confidence and assessment of probabilities of bond defaults going forward and or a U.S. recession. When we first covered this chart on June 5th, credit spreads 4.48%. Does the present day look better, worse, or about the same? The answer is better. Spreads are lower and they are narrower than they were a few weeks ago. And more importantly, credit spreads in the present day don't look like these concerning levels here. Like everything else, we're not using this to predict anything. It is possible that spreads will widen. They have not widened yet. The facts that we have in hand today still look pretty good. I think it's probably fair to say the economic data point that would most likely spook the bulls and spook the stock market would be a shocking and surprising tick up in the unemployment rate. We covered that topic on June 7th. Let's look at the latest data on the employment front. This initial jobless claims makes a low in January of 2006 and then starts somewhat of a ramping up or spiking look here. The shaded area shows the recession in the United States. The low is made in January of 2006. The S&P 500 peaks in October of 2007. Do we have a concerning and ramping up look in the present day? The answer is not yet. You can pause your video player and take a little bit more detailed look at this tweet. Calculated risk, Philly Fed, state coincident indices increased in 46 states in June. A lot of green on this map here. And you may say, this is volatile. You need to look at the 4-week moving average. We can do that. Don't really draw any bearish conclusions by looking at the 4-week moving average. As our buddy Urban notes, employment has rarely been this strong, which correlates well with the argument that a secular bull market may have begun in 2013 and may be ongoing. We have the extremely important monthly employment report coming a week from today, or next Friday at 8:30 a.m. Eastern Time. We have not seen anything over the past 4 weeks, including the data that was released on Thursday, July 25th, would spook us on this topic, but we'll keep an open mind about the data that's going to be released. Fed will most likely lower interest rates at 2 p.m. on Wednesday, July 31st, followed by Mr. Powell's press conference at 2:30 p.m. Eastern Time. I would say the probability of the Fed not knowing what Friday's employment report looks like, that probability is about as close to zero as we can imagine. Therefore, if the Fed somewhat disappoints, it is possible that it's telling us that the non-farm payroll report might come in a positive or as expected manner. Conversely, if the Fed surprises, maybe with a 50 basis point cut and a very, very dovish tone in the press conference, it might possibly foreshadow a weaker than expected payroll report on Friday. Moral of the story: we probably won't know the real outcome relative to these two events until the close of trading, at least on Friday, August 2nd. Speaking to keeping an open mind about whatever the reaction is to the Fed on Wednesday. That includes a bullish reaction or a bearish reaction. All of it could be impacted and or reversed by Friday's economic data. Cover the National Financial Conditions Index in detail a few weeks ago. How does it look today? Last time we checked in, it was at negative 0.83, which really didn't look anything like these concerning average readings and median readings before really bad things happened in the stock market. Have financial conditions worsened? And does this number in the present day look more like this number or this number? The answer is no. In fact, the latest reading that we have as of July 24th is identical to the reading that we covered a few weeks ago. Said another way, national financial conditions are quite a bit better than they were here or here, and quite a bit better than they were here, here, or here. A push back towards the center line and back towards these levels here would increase concerns. That may happen, but it hasn't happened yet. Clients and regular viewers may remember way back on Friday, January 11th, we put together some bull-bear roadmaps to help us with data going forward. This is the look of the S&P 500 and our moving average cluster as of the close on January 10th, 2019. This was 11 trading days after the low. All 4 of these charts showed the early stages of bullish scenarios with the same moving average clusters 11 days after the plunge low. Thus, basically, we wanted to know walking forward if the present day was going to look like these cases walking forward. Said another way, it would be helpful to know on January 10th, 2019, as we walk forward from that date, if this chart and market psychology, which is reflected in the chart, is morphing into something like this, or this. And we said way back in early January, in the bullish cases, we would like to see the S&P 500 clear and eventually hold above the orange 200-day moving average. We also said that in 3 of the 4 cases, we held above the 200-day moving average basically on the first attempt. If we fast forward to the present day on July 25th, 2019, without having to predict anything, these charts, at least from our perspective, were very, very helpful. It's pretty easy to say and see that the present day chart did morph into something that looks more like this, more like this, more like this, or more like this, relative to the bearish cases that we also covered 11 trading days after the plunge low on January 10th. All 4 of these charts show the stock market 11 trading days after a plunge low. And on January 10th, 2019, this was the look we said we wanted to avoid. We didn't want to see something like this, didn't want to see a failed breakout or something like this. We also said that we didn't want to see tepid price action in and around the moving average cluster. If we fast forward to the present day, once again, it's pretty easy to see that the chart from January of 2019 unequivocally followed the bullish script relative to the bearish scripts. This looks a lot more like these cases here relative to these cases here. And as of the close on July 25th, 2019, we still had a constructive look. We'll continue to take it day by day. It simply helps us with probabilities. It doesn't predict anything. You can pause your video player here, but the basic gist of this is that the bond market continues to be very, very overbought and very, very extended. And as postulated in this Market Watch article, history says that bonds may also be susceptible to a sharp bearish reversal. That is to be determined. Remember, way back on January 4th, we saw hard data, facts that we had in front of us that told us to keep an open mind about the possibility of a sustainable bottoming process or low. So let's look at some present-day data and leverage these concepts once again. It's a daily chart dated July 25th, 2019. It shows the percent of S&P 500 stocks above their 200-day moving average. As we've covered in the past, we're updating the concept of a breadth thrust and looking at data as of the present day. From an extremely rare and oversold level below 20% here, the market was able to make it all the way back to 77%, and that reading came on July 24th of 2019. How many times have we seen a similar move from below 20 that makes it all the way back to 77%? And more importantly, what happened next in the stock market? As you can see here, it's extremely rare for the market to get oversold in this type of manner, and even more rare to drop below the green line and then make it all the way back to the blue line, which is exactly what happened between late 2018 and July 24th, 2019. Something similar occurred here. We're below in 2011. We make it back to the blue line in 2012. Thus, our study will walk forward from this point here in the historical cases, which is similar from a probability perspective to walking forward from basically the present day or July 24th, 2019. Keeping in mind that we only have data going back to 2004, a move like this is extremely rare. It only came after a low in 2009, a low in 2011, and a low in 2015. This is the date here that is similar to July 24th, 2019. And this shows S&P 500 returns walking forward from these dates here. 3 years out, 100% of the cases were positive, with a median gain of 44%. 2 years out, the median gain was 32%, and 1 year out was 13%. In the 2015-2016 case, returns were somewhat muted, looking out 30 days, and negative, looking out 60 days, reminding us to keep an open mind about all outcomes, especially in the short run. I think it's pretty fair to say if the S&P 500 gained 109% or 69% over the next 5 years, that would align with the secular bull market thesis, meaning the bull market began here, it's ongoing, and something that just happened on July 24th, 2019 tells us it's well within the realm of possibility that the secular bull could continue for at least 5 more years. Not a prediction, it's just helping us understand the possible significance of a rare move like this. Yes, it's a small sample size. If you're concerned about that, you can pause your video player and read this here. Probably fair to say that this aligns with the secular bull market thesis. If you know technical analysis and market fractals, very, very easy to say that this breakout aligns with a secular bull market thesis. Is there anything else? It's hard to say that we wouldn't draw the same conclusion looking at this quarterly chart of the S&P 500 dated July 26th, 2019. Once again supporting the argument that a secular bull may have began in 2013, which would be very, very similar to this look here in the early 1980s, and after that, the S&P 500 rallied for somewhere between 18 and 20 years, depending on your starting point, telling us once again to keep an open mind about much better than expected outcomes in the years ahead. Our game plan, as always, is to take it day by day. Everything that we've said in this video is based on the facts that we have in hand today. If we get failed breakouts and we stay below this neckline here for a sustained period, we will have to reassess the probabilities and continue to take it day by day with a flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.